Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Very excited to be back in studios here today. Ez, a lot to talk about. Inflation data, earnings, Buffett shareholder meeting, regional bank stuff. But before we get into all that fun stuff, we also had a Warren Buffett shareholder meeting on Saturday. I watched that, the entire thing, which was, amazing. A lot to share with there. But we also had the Kentucky Derby, all kinds of basketball. I had a small little retreat trout fishing. So how's your world going, Ez? I know that you're a huge NBA fan. I don't know if you caught the Derby too or the Buffett shareholder meeting. That would shock the hell out of me if you watched that one. But
I didn't watch that, no. But seeing as how we are linked through through the spirit of Warren Buffett, I did have in the back of my mind. Was a little more preoccupied with, for the listeners out there, I actually live in Louisville, so I was avoiding the Derby until it was time, for the locals to come out.
Right.
Till that was good. But been a lot of basketball. Yeah.
Yeah.
A lot of trying to figure out why my archaic laptop doesn't work as well as it should. So
we can we'll fix that.
Yeah. No sweat.
But hey, I'm going real quick though. Who you got in the finals?
Oh gosh.
I'm going to go Denver.
Yep.
And who's Denver going to play? I thought it was going to be the Celtics.
I think it's going to be Denver and Philadelphia.
Yeah.
I wouldn't mind a Heat-Lakers rematch.
That'd be cool.
My Final Four for the NBA is going to be Lakers versus the Nuggets and the Heat versus the Sixers. And honestly, I think any four of those teams that win for different reasons would just be awesome for basketball.
Yeah.
I mean, I like them all. I'd love it if Jokic and that small market Jamal Murray, they could win. Would love it for AD and LeBron to get one more together. And then, of course, Philly hasn't won anything forever. And in the way Embiid's playing, and another title for Doc Rivers, who I think deservedly so is pretty overrated. So if you got another one, I think that kind of cement the legacy that people think he has for.
No doubt, man. I'm excited.
I'm a Doc Rivers fan. I'm just saying he does get a lot more benefit than he has proven.
Oh yeah, I'm excited. I'm gonna watch it all. But we got a show to do here today, and a lot to get over, or a lot to get to here in our time. Again, the reason why we do these podcast shows, for those that might be catching this for the first time, thank you for watching. Don't forget to like and subscribe. Hit the little notification button so you get an alert every time we do these podcasts, about every 2 weeks. And also don't forget to go to shepherdwm.com. We're actually posting a weekly blog on Friday. I type that up. I let everybody, know what happened during that week, why it happened, what does history have to say about the similar events. That way you can digest that over the weekend and begin to position yourself accordingly. That's what this is all about, because I know people watch the news. We have the news on here every day. I have it on my phone everywhere I go, even while I'm trout fishing. I get all these news alerts. And I know everybody reads the news, and that's great, but the news does a really good job of placating to human beings' emotions called fear and greed. We're all hardwired with them. I'm not knocking the news. That's their job, and they're very good at it.
Yes,
the one thing that I think they would be a better suited for society would be to share what history has to say about similar events, because it's almost never the first time we've gone through something like what we're going through right now, which is the case. And that's the reason why we do the show, is say, this is what's happening. This is what you see in the news, but also there's some historical precedent, and here's what happened under similar circumstances. Now we can begin to make a game plan. And the game plan that we've been laying out for our viewers of this show and for our clients specifically, we've been against consensus since around September or so last year, and we've been right. We've been right the whole time, and this is the truth is, this is the most hated 7-month 20% bull market rally in the history of mankind. This is the most hated one.
Yeah, I mean, I don't want to pat ourselves on the back. I'm going to here for a second because you're pressuring me into it. We have been taking names. What is it, Guardians of the Galaxy? Kicking names and taking ass. That's what you've been doing.
Exactly. And, you guys got me on a good one here today. I've already had a sugar-free Red Bull, one of those 16-ounce cans.
Bam.
Black coffee in hand right now. So,
and we had some audio issues before we started, and you had just navigated that with the patience of a saint.
Locked and loaded here. Well, that's only because I had a couple days on the water, fishing for some trout, which was amazing.
When we get done with this episode, it'll be all gone.
Yeah. I wish I could post that video of me catching a trout, but I can't get that one up on the website. At least I can't by myself. Maybe we can figure that out after this.
Throw it to me. You can put it on the YouTube page in the community.
It was sweet, man. Section. If anybody's ever been to the Al Sable River in Grayling, Michigan, it's a lodge called the Gates, and they call it the Holy Waters. It's like, wow, it's unbelievable. Great time. Highly recommended. I'll be back again next year. It's kind of like my little Zen moment. You know how like Aaron Rodgers has that dark period or whatever he calls that? A couple days on the water was kind of like my little Zen.
But unlike Rodgers, you don't end that 48 hours early because you want to go talk to Pat McAfee.
Exactly. Yeah. Pat, you're welcome on the show, though, anytime.
Like, how long do you go in that room? 3 days? He's like, yeah. 20 hours later, he's back in the chair. That's all I needed.
Right. Exactly.
I didn't need those 3 days.
Well, let's jump into it, Ez.
Let's do it.
Let's see. I wanted to, let's see, where should we start? Let's start with earnings. Because the one thing coming into this year that I think everybody can agree on is the consensus far and away was earnings going to be awful, earnings are going to tank, therefore the market's not priced correctly, and we're going to see a significant pullback in the S&P 500. A lot of pundits is what I'll call them, and these are highly educated people from some of the best schools in this country. They have some of the most prestigious positions at their firms. They're on CNBC, Fox News, CNN all day long. And a lot of them, the bulk of way past the majority, we're calling for the S&P 500 to probably fall somewhere around 3,400 or lower before they would start to get bullish on the market. And here we are, the S&P 500 sitting around 4130. I was calling for the S&P 500 to be basically right at 4,200 at the end of April. Got damn close to it. We were right around 4160, 4162, something like that.
Yeah, I believe so. Just south of 4170, I think.
Yeah. And again, we have not been in the consensus camp for 7-8 months now. And I've been writing about it, posting about it. And we've been right. The fact of the matter is we've been 100% right. But the bulk of investors seem to still be hell-bent on the fact that we're going to go through something worse than 2008. You're seeing that in the data. There's more cash sitting on the sidelines with both institutional and what I would call do-it-yourselfer investors. Mm-hmm. There's more cash sitting on the sidelines than even when 2008 happened. So eventually people are going to start to maybe watch this show or catch some of the information that's actually out there and available.
Yeah.
And when all of those investors start to rush into the market, obviously, the market's going to rip up into the right, and then I'm going to become a little bit more fearful, as Warren Buffett said, when others are greedy.
Right.
Because we've already been positioned for the things that have done the best so far this year, specifically technology. Tech is up 18% year to date. And earnings. So we had 452 companies. That's 90% of the S&P 500 have reported earnings thus far. If you just watch the news headlines, you would not know any of this stuff. The results are awesome, with companies' earnings beating the median by 8% and 77% of companies that have reported beat estimates. On the top line, so revenue, companies have beaten by a median of 5% and 75% of companies that have reported have been beating estimates on the top line revenue numbers. So where was the earnings recession? It didn't happen. Oh, yeah, there's some other historical data as well. So again, I talked about this in the most recent newsletter that I sent out to all of our clients, which we do that at the beginning of every single month. You can go to shepherdwm.com now. We didn't do this last year, the first 18 months that we've been in business. We're coming up on 2 years now in June, by the way. Super excited about that.
Looking for that employee party you've been promising.
We'll work on that. We'll get it in the calendar. But so earnings recession hasn't happened. As I mentioned, shepherdwm.com, we're now posting all the newsletters that I send out. So the newsletter, I send it out the first week of every month. I summarize what happened the prior month, why it happened, again, provide historical data, around similar events that we've seen in the past. So again, this is the most hated bull market rally that I've ever seen, and maybe in the history of the entire market. April was an okay month as far as that goes. S&P was positive 1.5%. NASDAQ was flat. Dow Jones posted a 2.5% gain. And finally, the small caps, so Russell 2000, saw a 1.9% increase. So we're still seeing a lot of bearish news out there. We're going to get into some of these topics here today. But the Fed decided to increase rates on May 3rd by 25 basis points. It was something I wrote about. I don't think that they should have done it, given all the stress on the regional banking sector. And the fact is, And the Fed Chairman Jerome Powell announced that, hey, there is a credit crunch happening in the regional banks. Like, who's going to ask for a loan right now and expect to get one with rates being where they're at? So essentially, the bank makes money on the spread. You know, you make a deposit, they pay you 0.01%. They lend long, let's say 3% on a mortgage. Well, when rates are at 5.25%, and they're only getting 3% on that mortgage, you can see where there's a problem.
Yeah.
Right. And the credit crunch that's happening is essentially doing some of the Fed's job for them. The question is, by how much? Is the credit crunch equivalent to a 25 basis point increase on Fed funds rate, or is it equivalent to a 100 basis point increase? That's kind of the debate right now. I think a lot of people are kind of in between those numbers, but the fact of the matter is that is doing the job for the Fed to some degree. We still have a bullish case. I'm going to continue to make that case here today. But something that we talked about last time, and it's a data point. And again, you don't have to take my word for it. Just go back and watch the last 6 months worth of, the YouTube postings that we've done. We've been talking about this for a long time. So everybody keeps talking about a recession still going to happen this year. There's a small chance of that happening depending on what the Fed decides to do in their next meeting. And I'll talk about that more in detail here in a second when we get into this regional banking stuff. But one of the data points that I pointed out is with the S&P 500, there's been 7 months of gains and 2 consecutive quarters of GDP data that's positive. So we got GDP data as well. And that wasn't as robust as what economists had expected, but it's still positive 1.1%. So under those circumstances in the history of the market, we've never had a bear market under those circumstances with 7 months of gains and 2 consecutive quarters of positive GDP. So the bear market is over if anyone cares about statistics or what history has to say.
Huh.
So that was something that we pointed out in the newsletter. We also talked about the excellent earnings specifically from technology stocks. So our sectors leading into this year, 3 favorite tech by far and away, our biggest weighting for pretty much every client. And we also really like industrials. So this is also something I pointed out in the newsletter. Again, check it out, shepherdwm.com every month. PMIs, and if those that aren't familiar with that index, PMI is a purchasing managers index. History would show when that index is less than 50, which is where it was at in the last report here a couple weeks ago, industrials see positive forward 6-month and 12-month gains, with a median gain over 6 months being 12.6% and over 12 months 21.5%. So our second favorite sector is industrials for that specific reason, and we've been right on that one thus far as well. Our last favorite sector is certainly energy. We're coming into the busy season, travel-wise, vacations, and so forth. And you've seen energy prices come down here recently. We've been adding to that position. We've been underweight energy. And when I say underweight, energy is about 5% of the S&P 500, so it's a small sector. We started the year around 2% energy on average for most clients, and now we're getting closer to that 5%, S&P 500 weighting there. So those are our 3 favorite sectors. We've talked about it all year long, and we've significantly outperformed the S&P 500 for the majority of our clients, depending on when they got started here with us. So we've been right, and that feels very, very good, although I don't ever feel relaxed when you have a debt ceiling issue that's still to be determined in Washington.
Yeah.
And that's all you're going to see here probably for the next several weeks. On top of that is this regional banking stuff we want to get into here. But on the most questions that I get, I just had one right before we got set up here today from a very good client that's retired. And it was all about, what's going to happen here from a geopolitical standpoint, as well as here in the States as far as our debt ceiling is concerned. And I understand the concern, and the news is going to do a great job of playing into a lot of those concerns. So people are watching the programs and they're selling their marketing ads, which I'm not knocking them, that's their job. But history has to show that they always seem to raise the rates, or they always seem to raise the debt ceiling, and they tend to do it at the very last second. I have no doubt that that's what's probably going to happen here this time.
Yeah.
Which is stupid.
Yeah. I mean, it's just playing with the emotions of the American people instead of just admitting what's going to go down.
Fear sells. Fear. And by the way, there's more annuities that have been sold this year than ever. And I think everybody knows how I feel about annuities. It's a tool designed for some jobs, can be helpful, but in general, it's a terrible product, and it only works under these kind of circumstances where the fear sell is the only tool that the insurance company has.
Yeah.
To drive those types of annuity contracts.
I feel like we need to start talking about applesauce after we hear the word annuities.
Yeah,
for some reason, it's just like, that's what it makes me think of.
It's a buzzword for me. Like I start to get a little agitated.
Yeah. You need to go drink another Red Bull, do some push-ups.
Do a couple laps around the building here. Yeah. So, and again,
there is an old episode in the arc on the YouTube page that y'all can go back and look from, I think, very beginning of season 2, where Joshua goes off about annuities, and it is get your popcorn and put that bad boy on a projector. Good. So
it is that good. I will say that, and I'll probably have to do another one, man, because there's just too many people buying these products that they just don't need them. But here nor there. Let's get into the big stuff here. So we got inflation data, CPI. April core CPI came in at 0.4 month over month, which was in line with consensus. Everybody was expecting that number to be hotter than consensus. It was not. And here's the big point. We think the report is good enough to keep the Fed in pause mode, meaning we do not expect a June hike. The bar for the hike, I think has been set pretty low here because what happened when we got that CPI data that came in as expected, Fed funds futures fell across the board. The odds of a June hike fell to 1%. It was as high as about 12 to 15% leading into that print.
Yeah.
That has now fallen to 1%. In addition to that, you're also seeing the 10-year Treasury fall well below 3.5. It's now, as we're talking here, 3.39, as well as the 2-year fell again. It was hanging out around 4% leading into that print. The 2-year is hanging out at 3.8% at the moment here. Now, what drove?
Wow.
Yeah, so there was 3 things. And this is what I freaking hate about the news. Yes, CPI came in line with expectations, which, again, was better than feared, right? Everybody thought we were going to see a higher number than consensus.
Yeah.
But what they do a terrible job of in the news is actually breaking it down in simple terms for individuals that are watching these programs or individual investors, et cetera. So how do we get to 0.4% month over month, which again was the consensus expectation, which was good. Obviously lower would be better, but it came in line with consensus expectations. So what really drove it? There were 3 things. Shelter X hotels was positive 0.23%. Used cars and trucks, positive 0.14%. And vehicle insurance was positive 0.04%. So before I get to the Shelter X hotels thing, let's talk about this used car stuff real quick.
All right.
I think this is the anomaly in the report. In our view, used car prices rose 4.45% month over month and was the largest swing component in the CPI data that we just saw. Now, I think that this is just a short-term blip. I don't necessarily see a whole bunch of people getting super excited about going to buy a used car with interest rates being where they're at. Obviously, if a used car or the car that somebody has just completely dies and they have to go get a new one, then that's one thing. But I don't think that that's the bulk of people out there on the road.
Right.
So to me, this is a short-term blip. Obviously, with rates being where they're at, it doesn't really drive a whole lot of incentive to go out and buy a new vehicle. Matter of fact, the new car average incentive to go out and purchase a vehicle increased, so meaning they're giving more discounts to buy vehicles, and there is no real supply chain issues if you go and look at any of the earnings reports from all these, large car makers, Ford, GM, Tesla, etc. So to me, this is a very short-term blip. And the vehicle insurance, that's a component of that. So those two are kind of intertwined. And obviously, that's not a big number there. The vehicle insurance being positive 0.04%. Last but not least, Shelter X hotels. That was the highest reading for the CPI calculation. It's also one of the biggest weightings of the whole entire CPI formula for coming up with that number. I would be willing to bet if there was a poll across America and people were to actually put in real leading economic data, as opposed to the lagging data that's actually showing up in CPI. So CPI looks at an equal weighting across all these measures for the prior 12 months, which means it's a lagging indicator. If you look at things like leading indicators, you're simply not going to have these higher numbers. And when you strip those 3 components out, the CPI month over month would have netted 0. Right? So the Fed themselves admit that there's the longest lag effect with interest rate increases is going to come from housing.
Right.
Right. Now, how do you make a house? Wood, concrete, copper, all these materials are trading either at or below pre-pandemic prices. So the CPI calculation specifically for shelter components have a enormous lag effect.
Yeah.
Right. So you strip those three things out, and that's how we got to 0.4. You strip those three things out, you're at a flat 0.0 month over month CPI calculation. So to me, this is all dovish. This strengthens the bull case that we've been calling for all year long. And with a Fed pause that the bond market's pricing in, the best economist on the planet is going to be the bond market. They're generally correct. The 2-year yield has fallen, as we just mentioned. That's supportive of valuations on equities, specifically when earnings are coming in better than consensus expectations. Again, the Fed odds of a June hike fell to 1%. That's obviously bullish. The three components that drove the CPI data, we just talked about that. And the PPI data that came out today also came in lighter than economists expected as well. So I think it's going to be very difficult for the Fed with a straight face to say, yeah, we got to keep going with rates when we're getting 11 or 10 straight months of inflation coming down. You can argue about the pace.
Yeah.
Obviously, this is a nation where we get a lot of information quick and we want things right now, right? We get 2-day shipping on Prime or better, and if it comes in 2.5 days, and we're just pissed off, right? So we can argue about, yeah, we'd love to see it come down faster. Of course we all would.
Yeah.
Right?
Right.
And we can make it come down faster. The Fed could just take rates up to 10%. That'd shock the hell out of everybody. And, there would be zero inflation essentially overnight.
Yeah, we make a lot of things come down faster that way.
Right. And that's not what they're going to do, obviously. But
no, that's not what we're advocating for either.
No, not at all. I don't think that they should have raised rates at all this year, but they did. And I think that that's the thing that the bond market's pricing in right now is saying, hey, you guys are going to give us all those interest rates back sometime before the end of this year. And I know that that's not consensus either, but the data is showing what it is. And we're going to look at the data and, look at what history has to say under similar circumstances. And as soon as the Fed pauses, every single time you get a significant market rally. And that's exactly what we're positioned for. And under those circumstances, technology is going to lead the way like it already has so far this year. And you'll obviously see the benefits from energy coming into the summer months and industrials. That money's getting spent over the next 10 years with the Inflation Reduction Act and the infrastructure bills. We can all argue as to whether or not we should be spending money. I don't think we should, specifically when we're still trying to fight inflation, but that's already been passed. That money's getting spent, and no matter what happens in election year 2024, that money's still getting spent.
Yeah.
So from that standpoint, I'm going to be positioned to benefit from all that. Now, we talked about CPI, we talked about PPI, we've talked about earnings. Let's get into some Disney stuff, Ez.
Oh, yeah.
You want to talk about Disney for a minute?
I'm down to rewatch Moana.
Yeah, well, with a 4-year-old in my house, it's all we all we get. Probably could quote that movie, by the way.
Nice.
Pretty good movie.
That's a pretty good movie, yeah.
Absolutely. So Disney's shares are trading down. I don't know where they're down at right now. When we started the day, they were down around 3-4% or so. Hopefully they're recovering here a little bit, but actually Disney came in with earnings right at consensus expectations. The problem is that everybody is looking at the streaming subscribers declined, and why that's the most important thing, I don't know. Disney already got to kind of where they were telling everybody they wanted to get to from a subscription standpoint, right around that 160 million subscribers. That came down a little bit to 157.8 million. They were at, or estimates were for 163.5 million. That's a Netflix driving type of data point. Right? Netflix is just streaming. Disney is a lot more than freaking streaming.
Yeah.
So Bob Iger, the CEO, famous CEO, quote said, "We're pleased with our accomplishments this quarter, including the improvement financial performance of our streaming business." What he's saying there is they were more profitable for Disney Plus subscribers. So the monthly revenue per paid Disney Plus subscriber rose 13%. That's what should be important. That's the reason why freaking Paramount and all these other streamers stock price are falling off a cliff. Yeah, they want to see subscriber growth, but more importantly, they want profitable subscribers. And Warren Buffett talked about this in his shareholder meeting on Saturday. It's a tough business. There will probably be some consolidation in that. It's not about how many subscribers we can get. It's about how profitable each subscriber is. And Disney Plus subscribers are now 13% more profitable from the fiscal quarter previously. But everybody seems to focus on the number of subscribers here. Jim Cramer actually talked about this today. before the market opened up around 9 a.m. And he's saying the same things that I am, and essentially the same things that Bob Iger's saying is this was a great quarter. He's extremely proud of what they're doing, and they're going to continue this sort of profitability, profits over growth from a subscription standpoint, which is exactly what they should be focusing on from a management perspective, and why the market's beating them up on this is baffling to me.
Yeah, well, they just see the losses in subscribers. That's it.
Right. And this again, that would make some sense to me if we're talking about Netflix, because that's what Netflix is. We stream. That's all we do.
Yeah.
So we need people and we need them to be profitable, but it's great if we can have more people because we're already profitable.
Yes.
Right.
Yeah, it's quantity over quality for Netflix.
Yeah. So, the question is whether or not we should be buying more Disney shares. I'm going to let this sort of hysteria play out for a few more days and we'll kind of go from there is my view. But absolutely stellar quarter. So, and I also think that the recession fears, play into the Disney trade here a little bit, because if the bulk consensus is we're for sure going into recession, which that should in and of itself, if you're an individual investor, you got to sit here and think for yourself for a second. If everybody says this is what's going to happen, it's almost never going to be the case. Maybe stew on that. Sit on that one for a little bit. Just make this simple. This game, Buffett's successful because he makes things simple. And if he doesn't understand it, he doesn't invest in it, right? Let's make things simple. Stew on that for just a second before we get into our next topic here.
We're going to marinate that.
Let you guys marinate in that one for just a second here. So we got Disney out of the way. I got that off my chest. I wanted to touch on this PPI data again here for just a second. So producer price index rose 0.2% month over month in April. That was slower than the 0.3% consensus from FactSet. And on an annual basis, prices moved up 2.3%, which is the slowest gain since January of 2021 and slightly lower than economists had expected. So the good news is for the Federal Reserve, trying to bring down prices without tipping the economy into a recession, and for markets that are hoping for a Fed pause in interest rate hikes, I think that we're starting to get very close to that. We had a chief investment officer at Independent Advisor Alliance quote say, for the second day in a row, we have had good inflation data, which should give the Fed the room it needs to take a pause at its next meeting. And that's exactly what we are positioning for, and that's exactly what you're seeing, as we mentioned earlier, in the Fed Fund futures, only about a 1% chance that there's a hike in June. So I think the Fed's going to start to look pretty darn stupid. And we talked about credibility. I touched on this in the newsletter that I did send out to clients. And I wanted to quote that for everybody here. April was a good month, and the only thing that would cause a recession is the Federal Reserve, in our view, here at Shepherd Wealth Management. The increased rates by 25 basis points, and they did that, in our view, to quote-unquote salvage their credibility and prove to the American public that they are steadfast and resilient on the fight against inflation, even though inflation has been falling off a cliff measured by leading indicators. Again, go check out my last 6 newsletters. If the Fed wants to keep its, quote, credibility, they have to ensure, first and foremost, the stability of the financial system. And that cannot happen if we continue to see bank failures due to interest rate increases. Humility seems to be a difficult concept for the Fed, but let's all hope they can humble themselves before they induce any further economic stress. So, economic stress, that brings us right into a big topic for today. That is regional banks. So PacWest is a regional bank, and it's out in Beverly Hills, which obviously being down here in Florence, Kentucky, we don't know a whole heck of a lot about PacWest Bank here locally, although you can check out all of their information as a publicly traded entity. And their shares are essentially falling, fast and furiously here today due to fears of, they're losing deposits. And basically what PacWest had to say on May 10th, which was yesterday, it had $15 billion in immediately available liquidity, which was way more than enough to cover its $5.2 billion in uninsured deposits. So they essentially had triple the amount of liquidity versus the uninsured deposits. Yet they're getting a ton of pressure from short sellers. That's been a huge topic of conversation here. and whether or not short selling should be allowed specifically for regional banks under this particular point in time. The reality is this. Warren Buffett talked about this in his shareholder meeting, is that effectively all bank deposits are insured, because the first and foremost mandate, the reason why the Federal Reserve was created back in like 1908, was financial stability. That is the banking system, right? We have 4,000 regional banks. I understand there's been consolidation of regional banks going, for the last 20 plus years, where there was like 14,000 regional banks at one point in time, I think 10 or so years ago. Now there's 4,000. Well, if you look at larger developed countries, Europe, Asia, there's usually 2 or 3 mega banks, right?
Yeah.
What is the advantage of having 4,000 small to medium-sized banks in this country? That allows us to recover faster from financial stresses. Think 2008, right? 2008 was the worst year in the stock market since 1929, when we had the Great Depression. The stock market in this country in 2008, 2009, lost approximately 50% of its value in about a year.
Yeah.
Right? If you were to hold on to those positions, the market essentially recovered it over 18 months, something like that. Why did we recover from such a dramatic event in 2008? It took a long time post 1929 for significant recovery in the financial system, right? Basically, World War II was the major catalyst that really bolted America forward, which is a completely different, topic of conversation for sure.
Yeah,
but it allows us to get out of these things faster. And the reason why, I'm a small business owner. I have a lot of small business owner clients. There's small businesses across the country. That is the backbone of the U.S. economy now. You just get treated so much better at a local community bank, right? They treat you better. They're willing to service. They're more willing to provide loans and work with you better. That's the reason why I left Fifth Third Bank.
Yeah.
Right? I live in Cincinnati. There's a ton of Fifth Third, depositors around here. The reason why I left Fifth Third Bank is because when I walked in there, I had to, sit down, wait a couple hours just to go talk to, not even the right person really. Yeah. And the red tape and the hoops you have to jump through just to maybe or maybe not get a small business loan. Right, it's just ridiculous. I go to a local community bank here. I bank at Heritage Bank, awesome bank, and there's a lot of really good community banks out here. It's not just the only one is Heritage. There's a lot of them. I walk in there, they couldn't be more excited to have a younger depositor, a younger business owner, first and foremost, because their average depositor is a little bit older, a local community bank, as you can probably imagine. And I walk in there, they're super excited to see me, got account set up right then and there, and I filled out a little bit of financial data, which my accountant had already pre-prepared. So I handed that over. And within about 2 days, right, there was financing available.
Right.
Awesome.
Yeah.
Awesome service. So that's the reason why this country, and I'm just one person, there's a lot of small business owners, I think like 30 million approximately across this country here, and obviously in all 50 states. That's the kind of service that they're looking for that the bigger banks aren't set up to handle, right? JP Morgan doesn't want to deal with me. JP Morgan wants to go, give Intel a $20 billion loan so they can go build a chip factory. That's the kind of level that these guys are playing at.
Right.
Right. They're not worried about, Shepherd Wealth Management here, right? Which is fine. That's not what they should be worried about. They should be dealing with the Intels and whatever else they're dealing with over there at those large mega banks. So it's super important from a financial stability standpoint that the Fed actually, play into that mandate. It's not just price stability. You're getting price stability. You've got 10 straight months of price stability going in your way. You're not there yet, but you gotta kind of allow the lag effects to take place here. We just talked about 3 components. You got 3 freaking components. Right. You're going to tell me you're going to die on the hill of used car prices spiking and shelter still showing higher? I mean, come on, man. They already talked about the lag effect for housing, so I don't want to beat that horse any more than I already have here. So I think it's all set up perfectly for a Fed pause. Those that are still calling for rates to go up. I don't know what you're seeing or smoking or dealing with here, but the regional banks, that is financial stability. If you can't solve that, you can forget about price stability. He talks about price stability. If you don't have price stability, it doesn't work for anybody in this country, no matter where you're at in the income standpoint. I agree with that in principle, but you're not going to have price stability at all if you have no financial stability.
Right.
And we are the reserve currency. Buffett talked about this again in his shareholder meeting on Saturday. He doesn't see how the U.S., the dollar, wouldn't be the world currency. He doesn't see a way for that not to take place here. So if we want to stay competitive at all with the other big, economies of the world, specifically in China, we have to have price stability, and we also have to have financial stability, and that should be more important than fighting this quote unquote, inflation credibility problem that you've only created in your own mind because you're a central banker and you don't want to say, oh, hey, my bad, guys, probably went a little bit too far here with rates. So maybe we want to pause here for a second. Now, that brings me to the blog post that we also have started. We've been doing that for the last several Fridays, so you can check that out at shepherdwm.com. So what was important on the Fed announcement? So previously, on the last Fed announcement prior to the one we just had, that was March 22nd, the Fed wrote, quote, the committee anticipates that some additional policy firming may be appropriate. This time, on May 3rd, those phrases changed. The phrase went from the committee anticipates that some additional policy firming may be appropriate to this time the phrase was modified, removing the words the committee anticipates. The Fed Chairman Jerome Powell highlighted this, describing it as a meaningful change. In other words, he's leaving the door open for a pause. I don't know why they like to tinker with grammar and point to like, hey, man, this is a meaningful pause. Why don't you just freaking come out and say, we've raised rates 5%. Most of that came in the last 6 months, and you've already had 4 banks fall, and you got all this stress going on in the regional banks. Even you raise rates anyway in the, right in smack dab middle of all that. And what was really odd is that was a consensus vote.
Yeah.
Right? He was like, yeah, that was consensus. And the question was, well, was a pause brought up? And he was like, yeah, a pause was brought up, but not for this meeting. This is all about, these guys are just central bankers, man. They want to get their quote unquote credibility back somehow by showing that they're steadfast on this fight against inflation. You're seeing inflation fall, and you're allowing the regional banks to suffer significantly, although it is doing some of the work for you from a credit crunch standpoint. But is that really where you want to provide a whole lot of pressure? It's like having a patient on life support, and not doing anything, saying, oh, we're just going to let this guy kind of work through work through this problem himself, right? You got to provide some life support here, man. And your mandate, first and foremost, is financial stability. But you raise rates in the face of that anyway. Yeah. And you want to leave the door open with some little grammar words saying we may or may not pause at the upcoming meeting. I mean, come on, man. The bond market has called your bluff all year long, and now it's even going further in the other direction.
Oh, yeah. Like it's not even calling the bluff now. It's like the money at the bond market money is already on the table.
Yeah, it's already slapping them in the face saying, we're calling this bluff, man. You got, 2-3, and we're sitting here with 2 kings, and we just got a king on the flop. You know what I'm saying?
Also,
like
we've seen your cards. Yeah. That's the part of this game.
Yeah. And what's the problem here with all this? Again, this is the reason why we do this show. So the markets rallied initially, so every time Fed Chair Jerome Powell, he's got his pre-typed up, comments. Those are all excellent. Market rallied when he pointed out this little change in grammar. I had to make some notes here just to prove this to everybody. You can go rewatch the, I'm sure YouTube has the full press conference. Go check this out. Markets rally. Press conference started at 2:30. So from about 2:30 to 2:40, markets rally. You're seeing the S&P 500 and the NASDAQ hanging out around 1% or better. 2:40. Now we start to get some questions are being asked. So now he has to think on the fly.
Yeah.
And this is where the problem falls every single time. 2:40. Powell noted that, quote, a decision on a pause was not made today. That sank the market a little bit. A couple minutes later, 3:06, he noted that, quote, inflation is going to come down, not so quickly, and it will not be appropriate to cut rates. That's what he said. A couple minutes later, market comes down. Right now we're hanging around the flat to slightly negative line.
Yeah.
And then 3:18, a couple minutes later, he disclosed that, quote, support for a 25 basis point rate increase was very strong across the board, admitting that Fed officials, quote, did talk about pausing, but not so much at this meeting, end quote. And that sank the market for the remainder of the trading day. Obviously, we're getting some of those gains back, but mostly flat coming out of those press release comments from Jerome Powell. And now we're just seeing the news basically placate to two things. One, we have a debt ceiling problem. And that's basically a game of chicken that's taking place here in Washington. It's unfortunate that we're all going to be held hostage all the way up until, I don't know, we'll probably be asleep. It'll be like 11:50, Wednesday, May 30th or 31st, whatever it is, right before June 1st, deadline that the Treasury Secretary provided White House and Congress.
Yeah. It doesn't even seem like a game of chicken to me. Just like there's some random really drunk person in the street screaming and you're like, hey, go to bed. We know you're going to go to bed. Just go to bed.
Yeah. And in the history would show, we always raise either that or we'll kick it down the can and we'll be right back here having the same conversation in September.
Probably.
I really hope.
Because of elections.
Yeah, probably. You're probably right about that. That's what I would anticipate.
Yeah. They'll do it in the middle of the night, something to answer to it, or they'll just kick it down the road till.
Yeah. And the market's gonna freak out because that's what, people do because we're all hardwired with fear and greed. We all haven't changed in over 2,000 years. The one thing that Warren Buffett said about human beings that we know for certain is that they do not learn from history, and that's why we're here to provide this history. I don't think that whether you agree, disagree with the Congress or the White House and the administration, I don't think the White House wants that blood on their hands by not raising the debt ceiling. They got way more to lose if you're just looking at the politics of this whole situation than I think anybody else does. Maybe some people would disagree.
Not like, everybody.
Yeah. Yeah. So, I mean, it's going to get raised. You see all these people, all these senators coming out saying it's going to get done, but it's probably going to be held hostage all the way up until the very last second, or they'll just kick it down the line like we talked about here. So that news hopefully will no longer be news here in the coming weeks. I mean, they have to get it done. We cannot default. That just simply cannot happen.
Well, yeah, correct me if I'm wrong. One of the things that stops happening is that government employees don't get a paycheck.
Right. I mean,
so there's no way those greedy senators and Congress people are going to be like, oh, let's not pay ourselves.
Right.
That never happens.
Right. And, the president would then have to make very difficult decisions on, Social Security. Do we pay all that out? Do we pay a portion of that out?
Well, we'd stop
medical benefits,
Ukraine and
retirees. Right. There's just too many things, right? It's going to look awful coming into a presidential election year. So that's why I think the way that I think the market really isn't pricing in right now as we're sitting here talking today on May 11th. I don't think it's pricing in, a debt default. And it probably should not price that in either relative to what history has to say.
I mean, it seemed, every time this has come up, the debt default, since 2008, I feel like it's been almost this level of a big deal.
Yeah. I mean,
they've been like, we're not going to do it. It's like, oh, wait, then I wouldn't get paid Friday. No. Totally going to do it.
Right. And you can say the same thing about all the regional bank stuff, right? I mean, why does Warren Buffett come out and basically tell everyone that your deposits are fine, even though the FDIC, the Treasury Secretary, and Jerome Powell, nor the White House will say all of your deposits are going to be fine? That's already implied with what's already taken place relative to Silicon Valley Bank depositors. Now, yes, the bondholders and the equity holders of Silicon Valley Bank, Signature Bank, all these banks that defaulted, they lost as they should. Obviously, the depositors were made whole. So that's already implied in the system. It would stop all the hysteria and probably make Jerome Powell's job a little bit easier. You don't have to ban short selling. All you got to do is say, instead of this being implied, you guys are all fine.
Yeah.
Right?
Just remind everybody the reality.
Right. Because bankers are losing not just to the Fed and their fight against inflation, but they're also losing to money market mutual funds now, where you can go get 4.6% on your cash. I love my community bank, but they're not paying 4.5%, on cash deposits. None of them are.
Yeah.
None of the big banks are. Why is that? Well, is because when you've already lent out, commercial loans, which is 64% of all community banks' loan portfolio, and those commercial loans were probably around 2.5%, 3%, right? And that's been on your books. Will be on your books for some time to come. And you happen to buy treasuries, that were paying 1 to 1.5% on your investment part of your portfolio. Now you got all these deposits leaving. Well, you have to have a certain amount of liquidity on your books to be a viable bank.
Yeah.
So you got two choices. You can go borrow from the Fed overnight window. Again, rates are 5 to 5.25. and you're only getting about 3%, 2.5% on interest income from the loans that you have on your books. And now you're not lending because of all the issues that are going on here. So I put a lot of the blame not on the Federal Reserve Chairman. I put it on the FDIC. I put it on Treasury Secretary Janet Yellen. They came to the rescue for depositors at Silicon Valley Bank and others. Why not just come out and say, hey, for the rest of this year or for the next 6 months or whatever, there's a solution here. There's plenty of options on the table that would it would solve this problem with regional bank stock prices immediately.
Yeah.
As soon as that news hit, short sellers would have to cover, and people that would like to go ahead and invest in some of these, really good companies that their stock price has just been beaten to hell, and they're significantly oversold in every technical analysis indicator, RSI. They're all trading well below the 200-day moving average, 50-day, 20-day. I'm in a position right now where I'm looking at, picking up some shares of these regional bankers just because of the depressed price levels. And I simply don't believe that, this country is going to allow these regional banks just to completely go, flatline and die. I just don't think it's going to happen. But if they just come out and say all this stuff, short sellers got to cover, you get an immediate rally in regional banks, and that's going to provide a ton of relief for individual investors that are stressed out about this entire situation. And then you have really one more thing to worry about, which would be whether or not the White House and Congress decide to raise the debt ceiling, which they're going to have to.
Yeah, I mean, I can't stand the fact that this is yet again a conversation about it, and it's obviously what's going to happen. Like you said, one of two options. Both of them end with the debt ceiling being raised and
Correct.
Everybody going on for 2 years like nothing happened.
Right. So I'm already counting that as that's going to happen.
Yeah.
And I'm already counting on the fact that, if your mandates financial stability, these regional banks and their depositors are ultimately going to be fine. And this is a lot of short-term panic. I'm trying to take advantage of the panic because history would have to say that they will raise the debt ceiling. History would also have to say that they're not going to allow regional banks to collapse. I mean, hell, that's how a lot of Congress people and senators got to the position that they got to, is a lot of their support from the regional banking community. I mean, that's how job growth, positive GDP happens. Right? You have to have liquidity in the financial system for businesses to invest in their companies, their people, and grow and produce more jobs, more opportunities, so on and so forth. So that's the show today, Ez. I think we killed it. We got through a lot of topics here.
I think we're going to have to switch the pre-show drink from coffee to Red Bull.
Yeah.
Because that was awesome.
And, that was the fastest 45 or so minutes of my life.
Oh, yeah, we're pushing on 48 now.
Yeah, I love it. And by the way, tech stocks are ripping, even though everybody's worried about all this stuff that I just kind of rattled through here. So obviously the bond market's seeing something that I see, and eventually the rest of the investing population will as well. I'll be sitting right here saying, I told you all so. And,
or we'll be out of a job and hunting for a possum.
Well, there's always the El Sabo River. We'll come back to that. But I appreciate everybody watching the show. This is great. We do this every 2 weeks. Again, don't forget to check out shepherdwm.com. A Friday blog post will be going out there. All the newsletters are going to be sent there at the beginning of every month. Don't forget to like and subscribe to the Shepherd Wealth Management Podcast. Hit the little notification bell. We'll get you an alert every time we post one of these. It's been an honor and a privilege to be able to do this once again. Hope everybody enjoyed it. Hope you have a great rest of your Thursday. Have a great Mother's Day weekend. Don't forget to flowers, candy, nice dinner. I'm taking my wife out to a nice dinner. Yeah. Whatever you need to do, don't drop the ball on Mother's Day. So,
I got to put my money in my mom's commissary in the penitentiaries.
Yeah. Do not buy like a treasury bill bond and go give it to her. Even though it's getting 5.3%, it's not bad, but maybe stick with flowers and the traditional Mother's Day things. But anyway, we'll get back to everybody in a couple weeks. Hope you enjoyed the show. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management, and look forward to doing this again in a couple weeks.